line I love to say is like a feel-good way of losing money is to invest in great company without looking at the price. Because a great company need not be a great investment. Unless it's at a great price.
Hello and welcome to Market Pillars Uncovered, an educational series where we bring you insights from the leaders who are shaping India's financial ecosystem. Today's episode is no exception. We're thrilled to be welcoming on board Mr. Vikas Gupta, the CEO of Omniscience Capital, a firm that merges the principles of science with the world of investing, and I'm sure the results are exhilarating to watch. So we'll hear from Mr. Gupta on how exactly is his approach so different from the plentiful of others that are already deployed, the industries that he watches out for, and how you can invest not just in Indian but also global markets. Mr. Gupta, thank you so much for joining us today.
Welcome. Pleasure to be here.
So let's first understand your own journey. It's not just the Indian markets, but even the global markets where you've had some exposure. You've had experience in the United States as well, and now you're in India. So tell us a bit about your own career, what brought you from the US to India?
Simple one-line answer is, of course, Desh Bhakti, right? I mean, it's your country, you want to come back. But what we were seeing even that time is already countries like Taiwan, Korea, etc. having grown very, very fast, and China was on the way. And we were expecting India to do the same thing, right? And of course, India is a little bit slower, but now I think is the time when things will change. So we started out as a more scientific, tech-oriented journey, but was observing the markets throughout the 90s, during the dot-com boom bust, but then of course because of the dot-com boom, the tech-oriented pull was there, so we started a tech company and doing all of that. And then the bust came, and then you started learning that, okay, now you need to figure out your own business, right? Nobody's going to fund it, and so on. And then we got into tech consulting, management consulting from the entrepreneurship side, and then we were advising some tech companies to raise funds, etc., or to do M&As. And then slowly got excited towards the venture capital side. Because we realized that if, as an entrepreneur, you're going to do 3 years at a time, let's say you work on a company, you have 10 chances in your career, right? Maybe let's say 30 years, you have 10 chances, and one of them has to succeed. While if you are the VC, you have 25 allocations at the same time over a 5-year, 6-year period, and one of them is going to be a super multi-bagger. So this looks much better. So why not go on to the other side? And then that's how the investment side started taking off. Right?
Okay. So, and I understand you're an engineer by education, and now you developed something called as the scientific investment approach. Right. So how are the laws of physics working with analyzing PL&L and balance sheets? I really want to hear about how that works.
Right. So you must also have heard, I mean, everyone, Elon Musk is extremely famous, right? Yeah. So he talks about this, all the physicists talk about this, is first principles based approach. So you go to absolutely fundamentals. So first principles is where you start, and that's how you get innovation. Like all the things like Musk has done. And of course that when we started, there's no Musk. I mean, we didn't know, right? But we knew first principles, and that's how, and when we came to the markets, we saw so many approaches, right? Okay. So many approaches, technical, momentum, derivatives, event-based trading, fundamentals, quant, algo, AI, there's so many things you can keep doing, and global macros, etc. And so we needed to cut through that, and instead of learning each, we said, let's just go to the absolute basics. And from the basics, we built up, one by one principle, and that's how we reached the scientific investing approach. And it just happens that it's all common sense. Everyone knows all these things, but they don't follow it, or they haven't put it together the way we do. And so the results are different. If you do the same thing as everyone, you'll get the same results. If you do different things, you'll get different results.
Yeah, absolutely. And I think it's very important to deploy that differentiated approach, because in today's day and age, there is this, that age of information asymmetry has, well, more or less gone, you know. So how are you using that information that's available to everyone differently in your investing approaches? I guess what makes you also stand out. So tell us then, using the scientific investment and the, you know, the first rule-based, principle-based approach, is there any industry or sector that stands out to you at this point?
Today?
Yeah,
so today, I mean, it's right in front of everyone. And so before I'll give you an example of how this worked. The reason is because otherwise people say, okay, I know this industry, there's no big deal. Why is it an investment? So I'll just give you something else. 2016, Apple, the largest company in the world, was trading at $530 billion market cap. Largest company in the world, most followed by Wall Street. All more than 50 analysts from Goldman, Morgan Stanley, UBS, etc., you name it, and fund managers from managing trillions of dollars together, right? Everyone is tracking this company. Now let's get into the balance sheet. You're a CA. You told me just now, so with an amazing background in Deloitte. So I'll just get into a little bit technical, right?
Sure.
So $530 billion market cap, $235 billion cash. And about 60 or 70 billion of debt. So the net debt is, take the enterprise value, you adjust all of that, that's about 360 billion. And guess what the free cash flow and profits were? Net profits was $50 billion for a company which is selling at EV of 360. So 7 times effectively PE, you can call it, right? Or you take the free cash flow, it was even larger at 70 billion. So company, world's largest, most entrenched company, is selling for 5-7 PE. Right? That's crazy. It doesn't make sense. But it was. The reason was, what is the Wall Street view? Wall Street view was, it's been like 4 to 5 years now. 2011, Steve Jobs passed away. And now no new products have been launched. No mega large new products have been launched. And it's 2016. So we are worried about growth. Where will growth come from if there are no new products? And that's why everyone was negative. Now, OmniView, what were we seeing? And this is all captured in an article on thestreet.com. So it's there, recorded, live. So what did we see? We saw that this company has an installed base of more than 1 billion devices. Okay. So, and which has a replacement cycle of 3 to 5 years. Somebody replaces early, somebody replaces, but on an average, let's say 3 to 5 years. So 4 years. So 250 million devices are going to be replaced every single year. And you do an average price of the device and all that, and you'll get what is the replicable, consistent revenue of the company. And you know the margins, so you can actually predict the cash flows. So there was no worry in terms of sustaining the company. Next question was growth. If you saw the company, you would say they had reported around $10 billion of R&D. Now, R&D is not something which happens like I invest this year and I get a new product. It's like a 5-year cycle. So my last 2-3 years of R&D and next couple of years of R&D bunched together, it's like 5 years of R&D is going to come up with new products in the next 5 years. If I add up 5 years of R&D, that is $50 billion. Now you don't know what is going to come out of it. How do we quantify it? So we said the closest thing to innovative products is Silicon Valley, right? So let's look at what is the total assets under management of all the venture capitalists in US put together, so that we have an idea of what does 50 billion mean. So that was around 350 billion total US venture capital assets under management, and they were going to expect something like 1,000 unicorns coming out of it over the next 5-10 years. So we said 50 billion is nearly 15% of this whole thing. And so conservatively, at least 100 to 150 unicorns would be emerging out of Apple's R&D. Yes, unfortunately, no big thing has happened from 11 to 16, but we can't be negative. This is the second point. So growth is a given, and we know the kind of rough quantum of the growth as well. Third thing, the company had announced, and this was known to everyone obviously, that we are going to do a buyback of 250 billion in next 2 years. So 50% of your capital is coming back in next 2 years, committed by the company. So this is what we saw. And now, 9 years later, what is the market cap? It was half trillion, now it's 3.5 trillion. So right in front of everyone, analyzed by everyone, the smartest guys, their company can be so severely mispriced, right? Now that I've given you what is there, and you ask me the industry today in India, and that's banking. Okay. So everyone knows it's the largest market cap, share in Nifty, etc. But severely mispriced. Everyone knows, but it's not unlocked yet. Okay. Right in front of everyone's nose, just like Apple, this is a mispriced industry. Completely clean books now. NPAs are significantly low. It's below 1% net NPAs for most companies. Huge unutilized lending capacity. Like CRAR, which RBI gives, for most companies is around 15 to 16% or more, and can be as low as somewhere around between 9 and 11 depending on various things. So you have nearly 40-50% kind of unutilized lending capacity. Growth is bound to happen. The reason growth is bound to happen, right now also it's happening nearly double digits, 9 to 10, sometimes 11, sometimes 9. So it's quite a decent growth rate, but it's going to spike. The reason it's going to spike is the total plans of capex itself, just from the government. I'm not even going to the private sector. Just from the government is in nearly $1 trillion plus. Okay, if you take different sectors, and all of those are interesting as well, where the money is going to go. But the overall infrastructure spending, so at least 200 lakh crores is the kind of capex required over next 5 years or so. Majority of it has to come from the banks. So the growth, and that's the total book size of the banks today. So they're going to double in next 3 to 5 years, their books. And if it doubles in next 3 to 5 years, you can calculate the growth rates. Doubling in 5 years is 15% CAGR for their lending book, asset growth. And if it's 3 years, it's 25% CAGR. Now, we don't know which number will work out. Nobody knows the future. But this is the demand side. And you're getting PSUs at single digit.
Very cheap valuations.
Even the private sector, very cheap, compared to what is going to come. And the ROEs are yet to go up, because again, you have underutilized capacity. So you're paying for it on the cost side, but you're not getting paid on the revenue side. And you have this fixed cost. So ROE is going to accelerate.
Increase.
Earnings will accelerate. So this is our hypothesis. This is what we think is the best opportunity in the market today.
Okay, that's very interesting indeed.
Yes.
I think you dropped 2 hints during this answer for the next few industries you're spotting, and you can correct me if I'm wrong. You mentioned about how the government capex is going to flow, and there are some industries that it's going to flow in. And the other hint you dropped in was public sector. So is that the next industries that you would want to keep on your radar, or am I mistaken? It's just a guess I'm reckoning.
No, absolutely. Infrastructure is the overall infrastructure spending from government is really mega. It's unimaginable. And like if you extrapolate from today to 2030, when we would be somewhere between 6 to 8 trillion, and then you extrapolate to 2035 when we are closer to 10 trillion, and you start calculating not only size of the GDP, but also the size of the budget, because more and more money will be available.
Yes.
And if you track the last several years, like nearly a decade, we've been increasing the budget, but all of that is going to capex. Majority of the increase is not going to the revenue spending, it's going to capex.
Yes.
And if you do that now for next 5 or 10 years, it's a very, very large number. It's in fact much larger than what the US or Europe is planning for infrastructure spending. We're talking trillions, literally. Just power sector is like 0.6 or so trillion. Defense, I need not talk, but most people are aware. But that's also, we are at 2% of GDP. We are likely to go to nearly 3 to 4% of GDP. So imagine 4% of 10 trillion.
Okay.
That's nearly 400 billion, right?
Yeah.
So 300 to 400 billion. Manufacturing, our target is at least 2 trillion by 2030. Exports, just exports, right? Total exports is 2 trillion, out of which manufacturing should be 1 trillion. By 2035, 2 trillion of exports is the target. These are the kind of things. Now to do all this, you come to how will this happen? You need power. Okay, so we did that calculation. We are using around 1.4 trillion units annually today. We would be at 4 trillion by 2035. And the capex required for that is huge. The reason everyone is underestimating, they're not looking at things like data center, which is going to be the largest power consumer, including Americans. Even they are not estimating the power demand which will be required. Because just to give you an idea, one AI chip from NVIDIA consumes the same amount of power as an American household does in a year.
Wow.
Which is the most inefficient or the largest
Highly
splurgers,
consumer,
right?
Yeah.
So it's one chip is equal to that, and the kind of data is going to come and the kind of AI which is going to happen, which we can't imagine right now. So data centers, second is electric vehicles, third is railways itself. Right now, railways is the largest consumer in India. Then will become number 3. And we use around 1,400 units of energy per capita right now. US uses 13,000.
Wow.
So we are 10%
10x,
nearly.
yeah.
Even China is 6,000. We are just modeling 2,500 by 2035. That's all.
Okay.
Which is roughly similar to, let's say, Mexico or something like that. And that itself is giving us such kind of growth rates. So power is specifically within the infra, power and railways. These are some of the things.
Okay, very interesting indeed. Tell us a bit about how much does market capitalization of a company play a role? Because you have large caps, mid caps, SMEs, a very big segment as well. And also what factors influence that decision?
So, see, the funny thing is India is actually a small cap market. The reason I say for the normal investor is because there are 5,000 odd companies if you take BSE, or at least nearly 2,000 if you take NSE, right? Let's stick to NSE, at least 2,000 companies, but only 100 are defined as large caps, right? By AMFI or SEBI, and 150 are mid caps. So if you take out the top 250, you're still left with 1,750 odd stocks. And if you use, let's say, like we use a criteria of roughly 1,000 crores market cap and above, to be able to concentrate on companies which are more transparent, they give out, that's 1,500 companies, out of which only 250 are large or mid cap. So majority of your choice set, while the market cap is all concentrated in the larger caps, but the choice set is actually in the small caps. So it's like, India is a small cap market that way. Or all good markets are small cap markets. Like US is also a small cap market, right?
Okay.
Yeah.
So you're basically agnostic to the market capitalization. If you like a business, if of course it, ticks the criteria with respect to industry, you're agnostic to what the market cap is.
Absolutely.
Okay.
The only thing we need to worry is we have different portfolios, right? The HNI kind of portfolios which are in crores, where we need to be worried about the liquidity. So that is, some stocks will not qualify for that. And then there is a platform like small case where we would have retail where it's fine, the liquidity is more than sufficient for that. So that little bit liquidity criteria we look at, not necessarily market cap.
Well, you're one of the top performers, as I understand, and clearly what you have mentioned so far, of course, it's very logical, it's very sensible, and it is working as well. So it's not just like a blueprint on paper. It's something that seems to be working because you've delivered very well. Could you tell us a bit about, what is it in your approach? Do you think that what you mentioned, your rational, your line of thinking is something that the rest of the market is not deploying as efficiently as you, or what is it that you have that helps you deliver that alpha?
So I'll tell you, Charlie Munger says, when you want to do something, one of the approaches which mathematicians use is invert. Okay, so there's a mathematician called Jacobi, he quotes him, Munger. Munger is Buffett's partner, right? So always invert. So we said, okay, let's invert. Why are you in the markets? To make money. So let's invert. How not to lose money, right? So first start with that. And that's why our tagline is Science of Alpha from Safety. We said market, the returns will come. We'll worry about them later. First, let's not lose money. And for that, we developed the whole scientific investing approach. So first thing, out of the 1,500 stocks, above 1,000 crores, what we do is we just apply multiple steps in scientific investing, like capital destroyers, capital eroders, capital imploders, and we take them out. So these were the ways of losing money fundamentally. We took all of those ways out. like bad balance sheets, loss-making companies, destroyers. Eroders are companies with no competitive advantage. Imploders are companies which are extremely overvalued. So that's another line I love to say, is like a feel-good way of losing money is to invest in great company without looking at the price. Because a great company need not be a great investment unless it's at a great price. Right? So once we have taken out all these things, we're left with hardly 100, 150 companies or even 80 companies. And this is where the hard work starts of where is the growth and all of that. And so because we have reduced the chances of losing capital, now you have the upside left. And if you do it right and you look at the value, the true value, then if you get something significantly below the true value or the intrinsic value, you're going to make high returns, but with safety.
Okay. Safety first.
Safety first.
Right. Okay.
Absolutely.
You have experience, of course, in the global investment landscape as well, having spent a good chunk of years in the United States. So tell us a bit about the opportunities that are there in global investment and whether those markets or stocks are as attractive as the Indian counterparts.
So when you go out of India, our first choice is US.
Okay.
Because not some other emerging market. We are already in the emerging market and in one of the fastest and largest. So we don't need exposure to another emerging market. I'm not saying the opportunities are not there, but first you need exposure to the developed market. And specifically within developed markets, most of the other developed markets are a little bit slow growing. But US, the GDP might be growing at, let's say, 4% nominal. But there are companies, there are more than 100 companies which have grown at 20% CAGR over last 10 years. Okay. So this is a lot of, and we know, we use so many of those companies in our day-to-day lives, right? All the big ones, we all know the FANGs and all of that. And we can't live without them. So they are innovators, they are fast growers, and not just in technology. You take bio, healthcare, there's a lot of innovation there, right? So many other segments also the innovation is there. And if you want exposure to that, it's good to be in the US market.
Is there something with respect to regulations and processes that Indian investors should know if they're considering global investing?
Yeah, so people think it's very difficult, but it's not at all difficult. It's in fact, many times it's easier or faster to get it done. Yeah, because I mean, if like our HNI platform, the account opening itself takes 2 to 3 weeks.
Okay.
Because so many forms have to be filled. We have to fill DMAT, broking, this, that. In the US markets, you can open an account online with some scanned documents. Okay, 3 or 4 scanned documents, couple of days the account is ready. Then you need to transfer through your bank through this thing called liberalized remittance scheme, LRS. So where RBI allows $250,000 per person per year. So for a family of 4, if you have, you can transfer actually $1 million.
Yeah.
And that's for all purposes, including if you're just traveling, vacationing, that also is part of that. But that gives you a significant chunk to invest.
Yeah.
And it's for investing, not for speculations. So you can't do like derivatives trading and all. You can invest in derivatives for hedging purpose, but you can invest in the stocks and all. That is absolutely fine. So you go to your bank, and then many banks have even started online. So you can just transfer online, or sometimes you have to visit, or somebody will come and do the paperwork. Again, 2-3 days, everything is done. So just in matter of 2-3 days, your money is there. It's visible in the account, and you can start investing. It's very easy. Of course, you have to declare it in the income tax. Yeah. There is TCS, right? Tax collected at source, but which you get credit for.
Okay.
So it's very straightforward.
All right, lovely. So tell us, Mr. Gupta, that stepping away from the markets for a bit, what's your life beyond investing like? So we've spoken about the science. Let's talk about the art part of it. What's the art of enjoying life for you?
So art, I'm very fiction oriented.
Okay.
So more of a reading kind of. Long time back, it used to be Ayn Rand and stuff like that. But, then Jorge Luis Borges.
Okay.
That's a South American author that talks. One of his chapters is the LF. It has nothing to do with our alpha, but just because of that, I like it.
Okay.
and for various reasons.
Yeah, I'm an Ayn Rand fan myself,
are?
so
Super.
I recently finished Atlas Shrugged and I loved
Great.
it. Yeah.
I reread it last year.
Yes.
Both
yes.
Fountainhead and this.
Ayn Rand fan heads do tend to reread some of her work because it's so fantastic. But a lovely conversation, Mr. Gupta. Thank you so much for sharing with us your unique approach to investing.
Thank you. It was a pleasure.
That was, of course, Mr. Vikas Gupta, and I hope you've had to learn something new from this discussion and perhaps consider deploying aspects of what he has shared. Thank you so much for watching. We'll be back with a brand new episode. Until then, of course, don't forget to hit the like and subscribe button on Money TV.